For the past few months, financial headlines have been screaming the same message again and again. Silver is crashing, gold is sliding, precious metals are losing momentum, and if you only follow mainstream financial media, you would think the entire metals trade is finished. But while the crowd is distracted by paper price volatility, something far more important is happening quietly in the background. Copper isn't breaking. In fact, copper is being treated very differently from every other metal on the board. While retail traders panic sell ETFs and futures contracts, the world's largest corporations are bypassing public markets entirely. They are securing copper directly from the source, locking in multi-year supply agreements, and pulling physical material off the market before the public even notices. Amazon Web Services is doing it, Samsung is doing it, major automakers, utilities, and data center operators are doing it, and they are not doing this to speculate on price. They are doing it because copper is no longer just an industrial commodity. Copper is becoming a strategic technology asset. In many ways, copper is beginning to function like the new gold, not as a store of fear, but as the foundation of the future economy. And that distinction changes everything. For decades, investors were taught to group metals together. Gold, silver, copper, all just commodities, all moving with inflation, growth cycles, or macro sentiment. But that framework is breaking down. What we are witnessing right now is a great decoupling inside the metals market. Gold and silver are increasingly treated as financial insurance. They are fear trades. They move when investors want protection, when uncertainty spikes, or when confidence in fiat currencies weakens. Copper is something else entirely. Copper is not about fear. Copper is infrastructure oxygen. If you want to build the future, you need copper. If you want artificial intelligence, you need copper. For most investors, the metals market looks simple. Gold goes up when fear rises. Silver follows gold, but with more volatility. Copper rises and falls with economic cycles. That mental model has been taught for decades. And for decades, it worked well enough, but markets do not stay static forever. Sometimes the most important change is not in price, but in who is buying, why they are buying, and how they are buying. Right now, the metals market is undergoing one of those changes, and almost nobody is paying attention. Open any financial news feed today and you'll see the same stories repeated. Gold is under pressure, silver is collapsing. Speculative traders are exiting metals. The conclusion is always the same: the metals trade is dead. But that conclusion is built on a dangerous assumption that all metals behave the same way. They don't, and copper is proving it. While gold and silver are being traded, sold, hedged, and liquidated in public markets, copper is doing something very different. It is disappearing, not in headlines, not in price charts, but in physical form. And the entities pulling it out are not hedge funds. They are the companies that are building the future economy. Amazon Web Services is not placing bets on copper prices. They are securing copper supply. Samsung is not trying to time market bottoms. They are locking in long-term access to physical metal. Automakers, utilities, data center operators, grid developers, they are bypassing exchanges entirely. They are signing direct, multi-year supply contracts. That behavior tells you something important. Copper is no longer viewed as a commodity input. It is viewed as a strategic dependency. And when an input becomes strategic, markets change. Historically, copper was treated as Dr. Copper, a PhD in economics. It rose during expansions and fell during recessions. But that framework assumes copper demand is cyclical. That assumption is now breaking. Because copper demand is no longer tied only to growth, it is tied to transformation. The world has committed to electrification, not as a trend, not as a theory, but as policy. Governments have written it into law. Corporations have written it into capital plans. Infrastructure spending has been approved years in advance, and electrification has a physical bottleneck. That bottleneck is copper. Copper is not just used in wires, it is used in power generation, power transmission, power storage, power conversion, power redundancy. Every system that moves electricity relies on copper. And unlike software, copper cannot be scaled instantly. You cannot download more copper. This is why copper is starting to decouple from gold and silver. Gold is financial insurance. Silver is partly monetary, partly industrial. Copper is economic infrastructure itself. It does not protect wealth. It enables production, and that makes it fundamentally different. This difference explains a strange contradiction happening right now. Financial commentators see copper prices moving sideways and assume nothing is happening. But industrial buyers see something else. They see tightening availability. They see rising lead times. They see supply chains becoming fragile. And instead of waiting for prices to react, they are acting preemptively. This is what structural demand looks like. It doesn't chase price, it removes supply. And once copper is embedded into power grids, data centers, EV platforms, renewable installations, it is gone for decades. It does not come back to market. It does not get recycled easily. It becomes locked capital. This is why visible inventories are becoming less relevant. Public warehouse data no longer reflects true availability, because more copper is moving through private contracts, closed supply chains, and corporate stockpiles. This is sometimes called shadow inventory, and it is growing. Meanwhile, retail investors are watching price charts and missing the bigger picture. Copper is not being accumulated for profit. It is being accumulated for survival, and that is a very different signal. The question is not whether copper demand will rise. That is already decided. The question is whether supply can follow. And the answer to that question leads us into the next chapter of this story. Because once you understand how copper is mined, you realize just how fragile this entire system really is. To understand why copper is becoming one of the most important strategic materials of the modern economy, you have to step back and look at what the world is actually trying to do. not what politicians say. Not what marketing campaigns promise, but what infrastructure plans, capital budgets, and physical construction projects reveal. The world is attempting something unprecedented. It is trying to rebuild the entire energy and industrial system while keeping the economy running at the same time. That transition has a physical foundation, and that foundation is electricity. Electricity is not new. What's new is the scale. Never before has so much of the global economy depended on electrical systems operating continuously, reliably, and at high density. And electricity has a material requirement. It needs a conductor. Copper is that conductor. There's a reason copper sits at the center of every electrification roadmap. It conducts electricity better than almost any other metal that can be produced at scale. It is durable. It is flexible. It resists corrosion. It handles thermal stress. These are not small advantages. They are the reason copper remains irreplaceable. Every major electrification trend multiplies copper demand, not gradually, exponentially. Let's start with transportation. For over a century, transportation was powered by internal combustion. Gasoline engines require relatively little copper, basic wiring, minimal electronics, simple electrical systems. Electric vehicles are different. They are not just cars with batteries. They are rolling electrical systems. An electric vehicle requires copper in high voltage cables, electric motors, battery packs, power control units, charging interfaces, thermal management systems. On average, an EV uses 3 to 4 times more copper than a gasoline vehicle. And that copper is not optional. You cannot reduce it without reducing performance, safety, or reliability. Now multiply that by scale. Governments across Europe, Asia, and North America have committed to phasing out combustion engines. Automakers have already allocated capital. Factories are being retooled. Supply chains are being rewritten. This is not a future plan. It is happening now. But electric vehicles are only part of the story, because vehicles don't operate in isolation. They require infrastructure, charging infrastructure, grid reinforcement, energy storage, all of which require more copper. Every fast charging station requires transformers, heavy cabling, grid connection upgrades. That copper does not replace existing copper. It is layered on top. This is a compounding effect. Now move beyond transportation. Look at artificial intelligence. AI is not software in the abstract. AI runs on physical machines. Those machines consume enormous amounts of power. And power delivery becomes a critical vulnerability. Modern AI data centers are designed with redundancy upon redundancy. They cannot afford failure. A single outage can cost millions, so they overbuild electrical systems. They use thicker cables, more transformers, more backup capacity. All of that means more copper. A single hyperscale AI data center can require thousands of tons of copper. That copper is used in power distribution units, cooling systems, backup generation, electrical redundancy layers, and unlike consumer electronics, this copper is installed in fixed infrastructure. It does not rotate. It does not churn. It becomes permanent demand. The expansion of AI is not slowing. If anything, it is accelerating. Cloud providers are racing to secure power capacity. Governments are competing to attract data centers. Entire regions are being redesigned around electrical availability. This is not speculation. This is visible in permitting, land purchases, and grid expansion projects. Now add renewable energy. Renewables do not plug into existing systems neatly. They require new transmission, new substations, new grid architecture, all copper intensive. Wind turbines require copper in generators, transformers, and cabling. Solar installations require copper in panels, inverters, and grid connections. But the real copper demand comes from connecting renewable energy to cities. That means long-distance transmission. That means copper. Energy transition plans assume massive expansion of renewable capacity. By 2030, global renewable capacity must nearly triple to meet targets. That is not incremental. That is a construction boom, and construction consumes copper at scale. Now consider one more layer: urbanization and electrification in emerging markets. Billions of people are still moving toward higher energy consumption. More appliances, more cooling, more digital infrastructure, all of it electrical, all of it copper dependent. This is why copper demand is no longer tied to GDP growth alone. It is tied to structural transformation. Even in slower economies, electrification continues. Even during downturns, infrastructure projects persist, because once electrification begins, it cannot be easily paused. This is the key misunderstanding skeptics make. They assume copper behaves like it did in past cycles, but past cycles were driven by discretionary growth. This cycle is driven by necessity. You can delay a luxury project. You cannot delay grid stability. You can postpone consumer spending. You cannot unplug data centers, and this is why corporations are acting now. They understand that copper availability matters more than copper price. They are securing supply before constraints become visible. They are building buffers. They are planning years ahead. The market price does not reflect this urgency, because paper markets respond to sentiment. Physical markets respond to reality, and reality is telling a different story. Electrification does not negotiate. It does not compromise. It either happens or systems fail, and copper is at the center of that equation. This brings us to the most dangerous part of the entire situation: supply, because while demand is accelerating, supply is rigid, and that imbalance is not theoretical, it is structural. In the next part, we will look at copper mining itself, how long it takes, why new supply is so difficult, and why even high prices may not be enough to solve the problem. To understand why copper is quietly becoming one of the most constrained materials in the global economy, you have to understand something uncomfortable. Copper supply does not behave like markets assume it does. It does not respond quickly to price signals, it does not scale smoothly, and it does not adapt to sudden demand shocks. Instead, copper supply is governed by geology, physics, and time, and those forces do not negotiate. When people hear that copper prices are rising, the instinctive response is simple. Higher prices will bring more supply. That logic works in many industries. It does not work in copper mining. Because copper mining is not a manufacturing problem, it is a discovery problem. Before a single pound of copper reaches the market, several things must happen. First, a deposit must be found, not theorized, not suspected. Proven, that alone can take years. Most of the easily accessible copper deposits on Earth have already been discovered. Modern exploration is expensive, uncertain, and increasingly unsuccessful. Companies drill thousands of holes to confirm what the geology already suggests. Many projects never move beyond this stage. If a deposit is confirmed, the next phase begins: environmental assessments. These studies are not formalities. They are multi-year processes involving land use, water access, biodiversity, and community impact. In many jurisdictions, these assessments can take 5 to 7 years. And that's assuming no legal challenges. After environmental approval comes permitting. This involves multiple layers of government: local, regional, national. Each layer adds time, each layer adds risk. A single objection can delay a project indefinitely. Then comes financing. Copper mines are capital intensive. A large project can cost several $billion before producing a single ounce of metal. Investors demand long-term price certainty. If prices are volatile or uncertain, financing dries up. Only after all of this does construction begin. Infrastructure must be built: roads, power, water systems, processing facilities. This phase alone can take years. From discovery to production, a new copper mine typically takes 12 to 15 years. That is not an estimate, it is an average, and that timeline has been getting longer. Now add another layer, or quality. The copper we mine today is worse than the copper we mined 20 or 30 years ago. In the early 2000s, average copper ore grades globally were around 1.6%. That meant that for every ton of rock mined, 16 kilograms of copper could be extracted. Today, the average grade is closer to 0.6%. That means only 6 kilograms of copper per ton of rock. This change is not trivial. It fundamentally alters the economics of mining. Lower grades mean more rock moved, more energy consumed, more water required, more waste generated, more environmental scrutiny, all of which increase costs. This is why copper mining has become so expensive. And why even at today's prices, many mines are operating near break-even. But there is an even bigger problem. Declining grades mean declining productivity. Each new project produces less copper per dollar invested than the projects before it. That is the opposite of technological progress. In most industries, technology increases output and reduces cost. In copper mining, technology is being used just to maintain output, not to expand it. Now consider geopolitical concentration. A large percentage of global copper supply comes from a small number of countries. Chile, Peru, the Democratic Republic of Congo. These regions face political instability, resource nationalism, labor unrest, environmental opposition. Each factor introduces risk. Each risk reduces supply reliability. When a strike shuts down a mine in Chile, there is no backup facility waiting to replace that production. When a regulatory change hits Peru, global supply tightens. This is not redundancy, it is fragility. Another common argument is recycling. Copper is recyclable, that's true, but recycling is not a solution to structural demand growth. Recycled copper often lacks the purity required for advanced electrical applications. AI systems, EV circuitry, high-efficiency transformers. These applications require extremely consistent material. Recycled copper introduces variability. Even more importantly, recycling depends on existing stock. You can only recycle copper that has already been used, but demand is growing faster than the existing stock can supply. That creates a bottleneck, so we have a situation where demand is accelerating, supply is rigid. New projects take decades, ore quality is declining, costs are rising. This is not a cycle. It is a structural constraint. Now look at pricing. Copper trades around $5 per pound. Many people assume this is expensive. It's not. For many producers, $5 per pound barely covers operating costs, capital maintenance, environmental compliance, debt servicing. There is little incentive to expand aggressively. To justify new large-scale projects, prices need to remain sustainably above $6 or $7 per pound. Not briefly, for years, but markets don't price long-term necessity. They price short-term sentiment. That creates a gap. This is why supply is not responding, and why it likely won't, even if prices rise. Because by the time new supply arrives, demand will have already moved further ahead. This is the core imbalance driving copper's transformation, not speculation, not hype, physics. And when physics collides with markets, markets eventually lose. In the next part, we'll explore how this imbalance is showing up in macro signals. Specifically, the copper-to-gold ratio, and what it tells us about where the global economy is heading. Financial markets leave clues, not in headlines, not in opinions, not in social media sentiment, but in relationships, ratios, flows, relative performance. And one of the most reliable relationships in macro history is the relationship between copper and gold. For decades, professional investors have watched the copper-to-gold ratio as a signal, not because it predicts prices perfectly, but because it reveals intent. Gold is defensive. It rises when investors seek protection from inflation. From currency debasement, from systemic risk. Gold does not need economic growth to perform. In fact, it often thrives when growth weakens. Copper is the opposite. Copper rises when economies build, when factories expand. When infrastructure grows, when construction accelerates, copper requires activity. When copper outperforms gold, it usually means one thing. Markets are rotating from fear to function, from preservation to production, from bunker mentality to build mentality. This ratio has quietly guided major capital flows for generations. During periods of economic expansion, copper leads. During crises, gold dominates. But what makes the current moment unique is this: the copper-to-gold ratio is rising without the usual macro backdrop. Traditionally, copper outperformance required strong GDP growth, booming construction, explosive industrial activity. That is not what we are seeing today. Growth is uneven, markets are volatile, geopolitical risk is elevated, and yet copper is holding strength relative to gold. This tells us something important. Copper demand is no longer purely cyclical, it is structural. Markets are not rotating because they feel optimistic, they are rotating because they must. The world cannot function without expanding electrical infrastructure, regardless of sentiment. This is why the copper-to-gold ratio matters so much right now. It is showing us a shift beneath the surface. Capital is being allocated not based on fear or greed, but necessity. Gold is still important, it still acts as insurance, but it does not power data centers, it does not charge electric vehicles. It does not transmit electricity. Copper does. This creates a new hierarchy. Gold protects wealth. Copper enables wealth creation. And in an economy defined by infrastructure expansion, the latter becomes increasingly dominant. This shift is also visible in institutional behavior. Large funds are not abandoning gold, but they are increasing exposure to materials linked to energy transition, electrification, and infrastructure. Copper sits at the center of that list. Now contrast this with public perception. Retail investors still see copper as a trade, something volatile, something cyclical, something to buy and sell. Institutions increasingly see copper as systemic exposure, a hedge against infrastructure scarcity. This difference in perspective is critical, because markets move when perception catches up to reality. There is another reason the copper-to-gold ratio is so important. It tells us when paper markets are lying. Gold is heavily financialized. Its price reflects derivatives, futures, ETFs, and speculative flows. Copper also trades on exchanges, but its physical demand is much harder to suppress. You cannot financial engineer power grids. You cannot roll over contracts to avoid delivery. At some point, copper must be delivered. This creates tension. When copper prices lag physical demand, the ratio rises, not explosively, gradually, quietly. That is exactly what we are seeing. Copper is not screaming higher. It is refusing to collapse, even as macro narratives shift, even as recession fears appear, even as risk assets wobble. This resilience is a message. It says the economy is not simply slowing, it is transforming. In past cycles, recessions destroyed copper demand, factories shut down, construction paused, inventories piled up, prices collapsed. This time is different. Electrification projects continue, data centers expand, grid upgrades proceed, EV adoption moves forward because these are not discretionary investments, they are foundational. This is why skeptics struggle to reconcile the data. They expect copper to behave like it always has, but copper is being pulled into a new role, a role gold once held in industrial economies. Gold was once a strategic material, it backed currencies, it settled trade, it anchored trust. Today, copper anchors infrastructure. This is why central banks hoard gold, and why corporations hoard copper, different assets. Different functions. As this realization spreads, the copper-to-gold ratio will likely remain elevated, not because gold is failing, but because copper is being repriced in its role. And this brings us to the next phase of the story. What happens when institutions stop trading copper and start withholding it? What happens when inventory disappears faster than price reflects? What happens when supply is quietly absorbed before markets notice? That is where the next part begins. If copper were behaving like a normal commodity, the story would be obvious. Prices would surge, inventories would collapse publicly, media headlines would follow, but that's not what's happening. Instead, copper is tightening quietly. And that quietness is precisely what makes this phase so dangerous for those not paying attention. The most important changes in commodity markets do not begin with price, they begin with behavior. Specifically, who is buying, how they are buying, and whether they intend to sell. And in copper, those behaviors have changed dramatically. Historically, copper moved through transparent channels. Miners sold to traders. Traders sold through exchanges. Inventories were visible, prices adjusted. That system depended on liquidity. It depended on copper circulating. Today, copper is increasingly being removed from circulation. Not hoarded in vaults like gold, but embedded inside closed systems, private supply chains, long-term contracts, corporate stockpiles. This is what analysts refer to as shadow stockpiling. Shadow stockpiling does not show up clearly in official data. It doesn't make headlines, but it has the same effect as hoarding. It reduces available supply. Large corporations no longer trust just-in-time procurement for critical materials. Recent supply chain disruptions taught a harsh lesson. Availability matters more than efficiency. When production schedules depend on copper delivery, price becomes secondary. A factory doesn't shut down because copper is expensive. It shuts down because copper is unavailable. This is why major corporations are bypassing exchanges. They are signing direct contracts with miners, multi-year agreements, fixed volumes, guaranteed delivery. Sometimes even financing mining projects directly. This behavior fundamentally changes market dynamics, because copper that moves through private contracts does not return to the spot market. It does not add liquidity, it does not soften price spikes, it simply disappears. Now look at exchange inventories. Visible inventories on major exchanges have been declining, but not collapsing dramatically. Why? Because the real tightening is happening outside those warehouses. Public inventory data gives a false sense of security. It suggests there is enough copper, but that copper is increasingly spoken for, allocated, reserved, committed. This creates a dangerous illusion. Prices appear stable, but flexibility is gone. Another signal comes from exchanges themselves. Margin requirements on copper contracts have been rising. This is not random. Exchanges increase margins when they sense stress, when volatility threatens delivery, when physical tightness becomes a risk. Raising margins discourages speculative trading. It pushes out weak hands, it reduces leverage. But it does nothing to create new supply. In other words, exchanges are quietly preparing for instability, not reacting to it. Now consider one more behavior shift. Institutional investors are changing how they gain exposure. Instead of trading futures, they are increasing allocations to mining equities. Why? Because equities represent access to physical production, not paper claims. Mining companies control the bottleneck. And when materials become strategic, control becomes valuable. But even mining companies are constrained. Many producers are hesitant to expand aggressively. They've been burned before. Past cycles taught them that overexpansion leads to collapse, so they prioritize balance sheets over volume, dividends over growth. This creates another layer of constraint. Even when prices rise, supply growth remains muted. Now combine all of this. Corporations pulling copper into private channels, exchanges raising margins, inventories declining quietly, miners hesitant to expand, demand structurally rising. This is not a market preparing for collapse. It is a market preparing for rationing. Rationing doesn't look like a crash. It looks like persistent tightness, higher floors, volatile spikes, sudden shortages, and when it becomes obvious, it's already too late to respond smoothly. This is why copper's repricing is unlikely to be gentle. It won't announce itself with a clean breakout. It will grind, then lurch, then reset expectations. At some point, physical buyers will overwhelm paper sellers. At some point, contracts will demand delivery. At some point, the gap between financial price and physical necessity will close. And when that happens, markets don't adjust politely. They adjust abruptly. This brings us to the final phase of the story. What does the future actually look like? Not predictions, not hype, but realistic outcomes based on constraints. In the final part, we'll look at where copper prices may stabilize, how volatility is likely to play out, and why $5 per pound may no longer be high, but simply the new baseline. When markets approach a structural shift, the most common mistake is to expect a dramatic moment, a sudden spike, a clean breakout, a headline that confirms everything. But structural shifts rarely arrive that way. They arrive slowly, quietly, and then all at once. Copper's future is unlikely to be defined by a single price target. It will be defined by a new floor, a level below which prices no longer stay for long, not because traders defend it, but because physical reality does. For most of modern history, copper was cheap enough that availability was assumed. If demand rose, supply followed. If demand fell, inventories absorbed the shock. That era is ending. Today, copper prices around $5 per pound are often described as high, but that description reflects outdated assumptions. It assumes abundant supply, flexible production, cyclical demand. None of those assumptions hold anymore. At roughly $5 per pound, many producers are not earning excess returns. They are maintaining operations, covering costs, preserving output. This is not the price level that incentivizes aggressive expansion. It is the price level that prevents decline. That distinction matters. To meaningfully expand global copper supply, prices must remain higher for longer, not spike briefly, remain elevated. Because mine development requires long-term confidence, this suggests something important. Even during periods of macro stress, copper may not behave as it once did. It may not collapse, it may compress, consolidate, shake out leverage, but then stabilize at higher levels. This is the behavior of a market finding a new baseline. Volatility will remain. There will be pullbacks. Recessions will still create noise. Speculation will still exaggerate moves. But the underlying direction is set by constraints. Demand is locked in. Supply is locked out. That asymmetry defines the future. At some point, the gap between paper markets and physical markets must close. And when it does, expectations adjust, not smoothly, but decisively. This is why many analysts expect copper prices to grind higher, not explode, not crash, but steadily build a higher floor. Each dip gets absorbed by industrial demand. Each consolidation tightens supply. Each delay in mine development pushes pressure forward, and eventually price must reflect necessity. This does not mean copper becomes a speculative mania. It means copper becomes boringly expensive, consistently, persistently. In many ways, this mirrors what happened to energy infrastructure in past decades. Prices rose. Volatility remained, but floors moved higher because the system required it. Copper is entering that phase. The most important takeaway is not about timing, it's about recognition. Copper is no longer just an industrial metal. It is a strategic input, a bottleneck, a foundation. Gold will always have a role as insurance. Silver will always straddle industry and money, but copper now underpins the functioning of modern civilization. You cannot electrify the world without it. You cannot digitize the economy without it. You cannot scale AI, renewables, or transportation without it. And once that reality is fully priced in, copper will no longer be treated as cheap, even at levels that seem high today. Markets do not change overnight, they change quietly. Then suddenly, copper's transformation is already underway, not in headlines but in contracts and infrastructure, in long-term planning. Those watching only prices may miss it. Those watching behavior won't. The world has chosen electrification. Copper is the price of that choice, and $5 per pound may not be the ceiling. It may simply be the starting point of a new era.